Welcome to episode 3 of the Agile Dashboard. My name is Joe Perfetti. I'll be your host. And today I'll be very pleased to welcome our special guest, Toby O'Brien, who's the Chief Financial Officer of Raytheon Technologies. The Agile Dashboard, presented by Duke Corporate Education, is a show dedicated to what's next and to make sure that we talk to leaders about how they're preparing their organizations for the future and making sure that they're able to successfully pivot to new opportunities. Today, as I said, our special guest is Toby O'Brien from Raytheon Technologies. Toby, prior to being the CFO of Raytheon Technologies, was one of the architects of the merger that created Raytheon Technologies. He was previously the CFO of Raytheon, and basically before that, he was the CFO of one of Raytheon's businesses. And we're very pleased to have you here today as a guest on our show.
Thanks, Joe. Good to be here.
So the format of our show for our audience, and we encourage you to put some questions for Toby or make some comments in the chat boxes as we're broadcasting live on YouTube and on LinkedIn, is we're going to talk to Toby with some questions for about 15 minutes, take one or two from the audience. And I also have two additional panelists who will be joining us. We have Scott Coert, who's a professor and vice dean at the Commonwealth School at Geisinger School of Medicine. And we have John Davis, who's a regional managing director at Duke Corporate Education. They will be joining us and coming back in about 15 minutes to continue on with the conversation. Okay, so right now, focusing on Toby, I'd like to start out with a very important question, which is, you were one of the critical architects of a merger in the aerospace and defense industry that created a $74 billion company with 195,000 employees. What was the rationale and thinking behind this transformative merger?
Yeah, so there were three things that really drove it, Joe. One, I'd put under the bucket of scale and diversification. The merger created the world's largest and most advanced aerospace and defense systems provider. And it's a platform agnostic company, has a balanced portfolio. It's roughly half defense, half commercial aerospace, and it's also balanced by geographies. Again, roughly half domestic, half international. It provides for resiliency through all different cycles, which we're unfortunately, seeing now with the pandemic. But the scale does matter. The size of the company provides flexibility around capital allocation decisions, around investment decisions, in what is a very, very competitive industry. Secondly is technology. Whether it be aerospace and defense or any industry, for the most part, technology is changing, and in many cases changing in an exponential way or at an exponential rate. And putting these two companies together that are steep in technology, we have north of 60,000 engineers. We have about $8 billion annually in customer and company funded R&D. And we have the ability now to share that technology between, left pocket and right pocket, the commercial aerospace side of the house and the defense side of the house. And we think that is all gives us an ability to accelerate technology into the business. And I think that
go ahead.
No, go ahead, Joe.
I was going to say, but I think that what I also saw was not just a transformation of the company, but also a transformation of your role as a CFO. Can you talk about how that's been evolving as well?
Yeah. So, at a high level, what I see here today and maybe over my last one or two assignments is the role that I've been in has become more strategic, or the nature of what I've been doing has been more strategic versus prior to that. I might have said it was more tactical in nature. And I think there's two things that are driving that. Coming up the corporate chain, some of those prior roles not as big in scale, number one, and more operationally focused. And some of those roles were also in, what I'd call troubled businesses that needed fixing. And real simplistically, the strategy may have been to fix the business, right? And then the tactics were discrete towards that. The last few roles have been in businesses that are performing well, high performing businesses, and clearly there isn't the need for the quote unquote fix, but it's really to think about, what's next, where are we going, what's happening in the marketplace, what's happening with our competitors. So we've clearly seen, or I've seen, that shift over the last, call it 5, 7, 8 years, to being, more strategic rather than tactical in the role. I think no matter what, one thing that doesn't change is, especially in the legacy Raytheon and even in Raytheon Technologies today, the CFO is a true business partner, right? Whether it be to the CEO, the business president, the general manager, because in our companies, we don't have COOs. Okay, we don't have chief operating officers, and the CFO, de facto, in that partnership with the leader of the business, assumes that role and fills that role as well.
And I assume, given the scale of the company with 195,000 employees, and people are probably one of your most precious assets, is the management of the people something you also started to take more responsibility for?
Yeah, I think for sure. I could have added to what's changed is, from less doing and more leading. And when I think of leadership, the first thing that comes to mind is the development of people. So absolutely, the development of the finance organization, historically at Raytheon, already out of the gate, 2.5 months into the merger, already spending time on that. Obviously, getting to know folks from the legacy UTC side of the house. We'll be putting together, succession plans, looking at what the different development type of opportunities, the experiential roles that folks need to continue to further advance their career and be ready to become a CFO at a point in time, if that's what the company believes is the right path for them, and if that's what they want to do. So it's a very key part of the role for sure.
Well, and I think, the merger closing in April 2020, you probably couldn't have anticipated the crisis that we're in today. So given that you wanted to create this balanced firm, how is Raytheon Technologies managing through COVID-19? Has anything changed as a result of that?
Yeah, so, I think real quick, we've kind of got, priorities, right? Number one was back to the people, looking out and protecting as best we can from a health and safety point of view, our employees. Number two, our suppliers. We're not, generally speaking, vertically integrated, so we have a heavy dependency on the supply chain. We have north of 12,000 suppliers. They range from, large companies like us to very small businesses. So we have been triaging the supply chain, not only for the near term, but the longer term, because we want to be prepared on the commercial aerospace side of the house when the market comes back. And we're doing that all in conjunction with our customers, right? How are their plans changing? How are they, thinking of things differently? We've been stressing to folks, focus on what you can control, right? There could be a lot of hand wringing over the environment, over the pandemic, but we can't control that. So we've been trying to focus folks on what they can control, double down on that. From a big picture point of view, the strength of the defense business is showing through right now, back to the aspect of diversification. And as you said, the playbook didn't have a pandemic in it when the merger closed, but we are seeing, as I mentioned, that diversification and balance playing through right out of the gate. The defense business is hitting on all cycles. There really is no impact other than a little bit in the supply base, but it pales in comparison to what we're seeing on the commercial aerospace side. So, defense is steady, it's strong. The commercial aero, our view and the view of a lot of folks is it's going to be 2+ years before air travel comes back to represent levels that were similar to last year into 2019. So clearly we are looking at our Collins Aerospace and Pratt & Whitney businesses, making sure we've got the right infrastructure, the right cost structure, to be positioned for down the road, right? We're not sizing things for today. We're sizing them for down the road, to be ready to capture the market when it does come back. We have shifted, maybe a year to the right. Some of the financial commitments that we had made around the merger, we had talked about because of the financial strength, the strong balance sheet, that we would return, up to $20 billion to shareholders in the first 3 years, obviously through dividends and buybacks, share repurchases. We shifted that out a year. We held the 18 to 20 billion. We pushed it out to 4 years, really because of the uncertainty on the commercial aero side. So, there's still a lot to play out there. But we did announce a dividend right out of the gate, a strong dividend. I think that our investors were pleased with. It showed the strength of the company, the financial liquidity that we have, the balance sheet strength that we have. And effectively, we've deferred the share repurchase, until we get through the pandemic. Not to mention, it would likely be politically incorrect to buy back shares in this environment with everything going on, even though there's an attractive price out there to do so.
Yeah, and so I want to touch on that because it strikes at the challenges that companies have with a short-term versus long-term horizon. I mean, I know you're on the quarterly calls. The analysts are probably really pushing you. So how do you maintain, and what would you say just to other people listening to maintain that healthy balance between, and I know you guys call it the core and edge at Raytheon. How do you fund that core, but still push the edge business in this environment where there's such short-term pressure on cash and such challenges with making those long-term investments? What would you say?
Yeah, I think a couple things. Number one, you want to come out of this pandemic or any crisis strong, right? So the good news is, again, we have a strong investment grade rated balance sheet. S&P has us at a A- rating. Okay, so even taking the pandemic into account and the downturn in the commercial aero. You want to also take the right actions, again, as I mentioned earlier, to have the right cost structure in place going forward. And, we could choose to hunker down and, literally curtail all investment activity. We haven't done that, right? We're still going to invest nearly $5 billion this year in a combination of internal R&D and CapEx. And the only adjustments we've made there are in alignment with what our customers are doing relative to either if they are canceling projects, deferring them. We're doing the same, right? We want to stay aligned with our customers, but we want to be stronger coming out the other end. And in particular, you mentioned the core and the edge, right? So the edge technologies is an example. Things that are more futuristic, not Jetsons type of futuristic, but down the road. And we absolutely positively don't want to lose ground to the marketplace, to our competitors in those areas, things around cyber, around hypersonics, around some of the engine technologies at Pratt & Whitney. So we're going to continue to invest in those. We'll relook at business cases to make sure the appropriate market returns are there for us, right, to rationalize and justify the investment. And then on some of the technologies that are more in the core, think of existing technologies. We've had a philosophy of upgrades that we work with our customers, kind of pre-planned product improvements, where every X amount of years, we're going to do something different, right, based upon where the customers want to go. And we've had pretty good success of getting customer funding to support that, as well as supplier funding, right? So we've kind of got not a balanced model, but a little bit different approach. That the newer stuff, the stuff on the edge, we want to generally fund, retain the IP to it, and control our destiny there. And we're continuing to do that through this environment.
Well, and I want to talk a little bit more about that because historically, and I've done a lot of work myself in the aerospace and defense business, including with your own company. Yeah. Basically, I would define your business as risk averse. And I would say that the average CFO is probably referred to by a business leader as Dr. No. So how do you not be Dr. No and allow innovation and investment to occur as a finance person, given what you just said about the challenges of the business case?
Yeah. So there's a couple things, right? We have, and I think it's a balance, right? There's always a balance. So I think first and foremost, we put and I'll get to the Dr. No part here in a second, right? we put a structure, a process in place around how we want our businesses and our folks to go about evaluating investments, right? And, typical types of things around what the market looks like, the timing. And you can't always get to that perfect answer where there's 100% or even 90+% certainty. And that's okay, if you follow the process. And in particular, if you understand, risk and opportunity, right? Downside and upside, and have a fact-based decision. And I think, if folks do that, if they can, come forward, even if they can't, guarantee something, we can make an educated decision on moving forward or not. And then, the ultimate kind of check and balance there is that we do assign annual and long-term, financial objectives, right, to the company, at the company level, to the businesses. And, you're only going to be able to miss on so many before you miss your, financial objectives, right? And then things change. So there's a little bit of a natural governor in that process. The yes to no, or changing no's to yeses, I guess, that's something that I've harped on with my broad finance team for quite some time, including, which may seem counterintuitive to folks, people that are in organizations or roles that are maybe traditionally thought to be more governance and compliance related, where you want them to say no, right, to make sure you're doing things in an appropriate way. But my pushback to them is, okay, if we can't do X, then you tell me what are the 1, 2, or 3 things we can do, because the rules the best. You're the gap expert, as an example. You tell the business, here are some levers you can go pull, or here's a structure that would be compliant. And some of the best ideas we end up getting are from the folks that are in those compliance type of roles, because they know how to appropriately work within the rules. They're the subject matter experts. And it's a bit of a cultural thing, and it's a bit of a mind wash type of thing to constantly reinforce that. So that's something we do. My leadership team does with their folks, and we try to ingrain it in people as they're coming up the ranks, so that it just becomes part of their DNA and what they do naturally.
I think I'm going to ask Scott and John to join us, but as we're moving them back to the panel, I do want to follow up on one last point on that. So what I think I heard you say, Toby, is that if I'm at Raytheon Technologies and I have a business idea and I don't know how to get it sold, if I were at a traditional company, the role of finance would be just say, tough, you're not going to get the money. And what you're saying at Raytheon is, instead of me coming to you and saying no, you're actually encouraging your financial team to help them get to a yes, and maybe
Absolutely.
think about it in an alternative way, or a way that could actually justify the business case.
Yeah, no, that's a good summary.
And I just don't see that in the marketplace. And that, again, as a finance professional, because so many people don't even want to give the time of day to distinguish why they would say no to a business case. And the fact that you actually want to be helpful, I think is something encouraging that a lot of people on this call can actually learn from.
Yeah.
So, Scott, do you have any thoughts that you've been listening in the background on the conversation?
Yeah, Toby, I love the Dr. No approach. And, Joe and I do a lot of work around Agile architecture. What do you have to put in place so your teams are Agile, so that they accelerate, rather than get stuck? What are you doing? What insights can you share with us about the training and development of your area CFOs, so that they approach this mindset that you've introduced them to? Because it's not natural, as you said. It's almost as if there is a compliance, a set of restrictor plates for the safety of the financial security of the firm. So what are you doing differently? What can we learn from your experience in building these CFOs?
Yeah. So one simple thing that we do, we talk about it a lot. As a leadership team, then my leadership team with their leadership teams. I did a finance all hand webcast at Raytheon Technologies a month or so ago. I mentioned it there. That was an element of the discussion. It is the constant repetition, but when folks are coming up through the ranks, what we try to do to help foster that as well, make sure they have the right experiences where, perhaps they're on the receiving end of the no. Okay. So that they're putting the idea forward, they're getting it rejected. Um, you know, Hopefully with, yeah, but you should try this. In some cases that, it's not perfect, to Joe's point. It's not perfect, right? I would be, kidding all of us if this is happening 100% of the time. But we put them in those experiences where they're on the receiving end of the no, so they know what it's like, and they can feel it. And then we also try to document, different situations and share them across the organization. If something happened in business X, we make sure it's documented and provided across to the other businesses so that they don't have to recreate the wheel, that they can share it with their teams, and things of the like. And we talk about it, right? I mean, we collaborate. We make sure we get the right people involved. Make sure we're not going over any lines one way or the other when we look at these alternative solutions. So it's a very open dialogue, open process that's reinforced at different levels of the organization.
And John, I know that this probably resonates well with you in this conversation because you focus a lot on leadership, particularly on the marketing side, which is great agile organizations like Nike. And it's got to be refreshing to hear a leader talk about this, especially as that role of finance is evolving.
Yeah, that's right, Joe. I appreciate that. And Toby, thanks for your comments on that, because I thought it is fascinating how you've looked at the role of the CFO as no longer tactical, but much more in the strategic realm, and what it implies for what you have to do in terms of the people, in addition to capital allocation decisions. It's obviously become a much more diverse and impactful portfolio that you have to deal with. And I'm curious, as you look at this, what do you think is important that future leaders ought to know about the key financial levers, for example, they ought to be paying attention to and understand to help ensure that their business stays competitive and healthy, knowing that there is more to what they have to do to be successful here, including the elements that you've mentioned that you're working on already?
Yeah, so I think in any case, understanding the market and competitive dynamics, number one, while not a discrete financial lever, is very, very important, because without being informed properly there, I think can lead to faulty or unintended consequences from decisions that are made. From specific financial metric, one of the things, as an example, we look at is around the evolution of products or programs, from their development up through their maturity to full production. Then kind of, do they get sunsetted into an aftermarket aftermarket type of concept, or do we refresh them and pull them back across that curve with, as I mentioned to Joe's earlier question, technology enhancements? And we look at that and the required level of investment along the way, the implications to the margin profile and cash, using margin as a surrogate for cash flow, the margin and the cash flow profile, and all along bumping that up back against the market and the competitive dynamics, right? Because what we don't want to do is we don't want to throw good money after bad, right? We want to acknowledge at times, okay, we had a good run and it's over, and we should have the right financial strategy, in place to sunset that product. Yeah. The other thing we look at is, back to the business case analysis. Given that there are not, unfortunately, unlimited discretionary resources for investment, we do really try to drive with leaders. It's a choice, and you need to make the right choice, right? It can also be a question of trying to reallocate investment between businesses, between product lines. So we have them do that. We have them obviously look at how competitive they are, what their competitive win rates have been in their respective markets. If they need to do things differently, are they not bidding enough because they're winning everything, and therefore they could be expanding their market, even if they were to accept a lower success rate, but grow the market and their business in absolute dollars. So those are just a few that we kind of cut across to help folks think of things.
And I just want to remind the audience, if anybody would like to pose a question, please put those in the chat. We are monitoring that and happy to post that. But before we do, I just want to add to what John was just asking about, Toby, and think about, the show's called the Agile Dashboard, and you guys are talking about metrics. And I want to focus on leading metrics. Like, are there any leading metrics that help you start to understand what could happen to the business, so they kind of are giving that early warning indicator, as opposed to the traditional metrics, which are kind of like looking in the rearview mirror?
Yeah, so there definitely are, especially for the new company RTX on the commercial aerospace side. Couple things that come to mind, RPM, or revenue passenger mile, which is effectively a utilization measurement for airlines, right? How much flying are people doing? And another one is revenue seat miles, and that's a capacity metric, right? How much capacity is available based upon the number of flights. And for us, in the commercial aero side, those are real strong leading indicators, not just what we're seeing in the month or the quarter, but also projecting out what's going to happen to them, because it will dictate things around airlines' plans to acquire new aircraft, to extend the life of their existing fleets. And because everything we do ultimately comes into the aftermarket, right? Whether it be a time-based maintenance overhaul, something breaks, et cetera, it's also a leading indicator of the level of volume we may or may not see in aftermarket, which is our most profitable part of our portfolio. The defense side's a little different, maybe not non-financial metrics in the purest sense, but there's a FIDP, or a 5-year defense plan, a future years defense plan that the president puts out. It's not, fixed, right? But it's at least a leading indicator of what we think defense spending would look like. And the other big thing there is more the threat environment. On the defense side of the house, it's the threat or the perceived threat that drives demand, right? So what's happening in Europe relative to what Russia is doing? What's happening in the Middle East relative to Iran or insurgency? And then, as an example, in the Far East, what's going on? What's North Korea up to? What's China up to? So those are the types of things on the defense side we would look at as well.
So I'm going to paraphrase one of the questions that I see in the chat, and we have another one that's coming in as well. But basically, I'll just want to say, I'll read this one right off this. But basically, what constraints do you feel you need to reinforce as opposed to things that have to change or adapt when you think about being a chief financial officer?
I like to not feel constrained, right? So what we try to do, and what I try to do, is focus on more what we need to do differently, or as the question was asked, what do we have to adapt? I mean, I think the role changes and the focus of the role, we talked earlier about bigger picture, how has the role changed for me? But it can change, week to week, within the quarter, year to year. And again, what we'll try to do is understand what's driving the change, what's happening in the environment with the company, and, put some either, guidance or, change some processes or focus based upon that. We try not to, constrain folks in their thinking, as much as we can.
So I think we have time for one last question. I'm going to take it from the audience. And so again, this comes from George Bennett, and I'm just going to kind of paraphrase what I think I'm reading here. But basically what I think he's saying is that part of the challenge that's embedded in the role of a finance person, a CFO, is to drive cost reductions and reduce costs through operational excellence, and to use those funds to fund the growth opportunities. Is the business such a zero-sum game where it's only going to be about cost reduction driving growth, or do you find other opportunities for investment at Raytheon Technologies as a CFO?
Yeah, so I think that the question or the statement as part of the question, is still relevant. It's still accurate, right? A key role of the organization is to drive efficiencies, drive, reductions in the cost structure. We make decisions on those as to whether or not they, flow to the bottom line or get reinvested in the business. Okay. And you could get a different answer this year versus next year versus 2 years ago. But there have also been times where we purposely, so my point about, we're not hunkering down, we're still investing close to $5 billion in CapEx and R&D. There was a point in time, an inflection point for legacy Raytheon going back to when defense budgets really came down in the 2010, 2011 timeframe because of sequestration. We actually, which was counterintuitive, we increased in absolute dollars our R&D and CapEx investment and took a hit to our margin and our cash flow as a result of it, all else equal, because of the opportunities we saw coming out the other end. So, yes, there are times, I think, when there are other ways to, fund R&D, including taking it out of the existing bottom line rather than self-funding it. There are innovative ways to work, obviously, with your suppliers and leverage their, investments as well as customers. So I think it's always, a menu of opportunities to think about and work through.
Well, I think it's refreshing to hear how people talk about when we reprioritize with a focus on the future, because building a sustainable organization is not easy. And it sounds like those investments in 11-12 paid off with what became, the merger that created Raytheon Technologies. So kudos to taking that longer term vision. So as we wrap up our show, and again, I want to thank everybody for their time today. Toby, do you have any final thoughts that you'd like to share in terms of lessons learned for future finance leaders that might be walking in your shoes, that you could kind of impress on some of the wisdom that you've learned about how the role of the CFO has changed and what they need to do in the future as they lead their organizations?
Yeah, I think that, the biggest thing that I would say for folks, especially if you're, earlier career, early mid-career, try to get as much diversification in the different roles that you go through as reasonably possible, right? Don't feel that you have to rotate jobs or make it up every 24 months. In some cases that may make sense. In some cases it may not. And get integrated into the larger organization. Don't think of it as, finance in a stovepipe, right? But understand if you're working with a program manager or a section leader, whatever it may be, right? Understand what he or she is doing, what the role in the group of operations is, supply chain, right? You want to get that total kind of knitted picture, because I think it makes you more effective, when you advance to other roles to understand that big picture. The other thing I would say is, understand as you move through the organization or through your career, your role is going to change, especially if you want a leadership role and you have to change with it. You have to know, I got to do less and lead more, right? And that's not always an easy thing for folks that have been more of an individual contributor, up to a point in time, right? We're all individual contributors until the first time we have people working for us, right? And you have to recognize that things are changing, and also recognize, you, third person, I'm only as good as my team is good, right? So back to your point earlier about the development of people, it becomes a much, much bigger element of what you have to do. And you got to let them do what you're paying them to do. Don't micromanage them, right? You've got somebody running accounting, your financial and out, let them do their role, right? That you're paying them to do. Make sure they're developing their teams, and always accept that things can change in a heartbeat, right? So it was one thing that we went into this process, evaluated, and went forward with the merger. And, by the time the merger closed, that was old news because it was announced, 10 months earlier. But what did change was the environment, right? And what we were all thinking of doing on April 3rd going forward got, turned upside down because of the pandemic. And I could tell you, I probably only did not even half as much of what I kind of had etched out for my first, 90 days on what I wanted to do. And it was replaced because with different items, a lot around liquidity, understanding downside cases, et cetera, because of the pandemic. So you got to stay flexible, adaptable, because you never know what's going to happen, and don't ever think there won't be that black swan event.
Yeah, I think, agility is here to stay, and making sure your organization is prepared for that, because there is so much uncertainty, and not be paralyzed by that, I think is a very critical skill. And again, I appreciate what you shared with us today. I hope we're able to continue the conversation beyond this show as we wrap up. Again, I wanted to sorry, can't talk today. Wanted to thank Toby for being our special guest. I know you're a very busy person, and appreciate taking the time out of the day to meet with us. I'd also like to thank Scott and John for joining us as well on the panel and providing their thoughts and comments. And I'd like to thank you for taking the time to view our show. If you'd like more information about the topics, feel free to reach out to Toby. He is at rtx.com, or you can also look at dukece.com, where you can find more information about our agility research. So again, thanks for attending today. And as I like to say, you can't drive a car looking in the rearview mirror. That will end our show. Have a good day, everybody. Good night.